Hi, this is Prasheel coming to you from Mumbai, and you're listening to the Equitymaster Stock Market Wrap Up. In this week's edition, I'll be taking you through what moved the markets over this week. So let's jump right in. In a week full of macro data, inflation measured by the Consumer Price Index, that is CPI, continued its steady rise in September, while industrial production fell to 3-month lows. Meanwhile, India's trade deficit, which is the difference between a country's imports and exports, narrowed to 5-month lows. The country's IT sector could be in for some pain going forward as the US seeks to impose new curbs on the H-1B visa. Now, just when you thought the markets were recovering, they backed down again. Volatile markets like these test the patience of the best of investors. Are you wondering what you should be doing in such markets? Well, that depends on what kind of an investor you are. Research analyst Girish Shetty will be joining us to tell us all about it, so stay tuned. Now, a quick look at the broader markets. Asian and European indices traded in red throughout the week as China posted its weakest economic growth since 2008. Back home, Indian indices witnessed volatility on the back of rising crude prices and a depreciating rupee. With the markets out of the way, let's look at the key stories in focus today. India's retail inflation accelerated in September, though it remained within the central bank's permissible limits. As per government data, CPI-based inflation rose to 3.77% in September from 3.69% in the previous month. Meanwhile, factory output measured by the Index of Industrial Production fell to a 3-month low in August because of a higher base effect. IIP fell from 6.5% in July to 4.3% in August. The volatility in the IIP growth rate indicates that the industrial recovery remains uneven and fragile even ahead of the festival season. The RBI's latest Business Expectations Index, however, shows that industrial activity has improved in the July quarter. Notably, after 2 successive hikes, the RBI's Monetary Policy Committee kept interest rates unchanged on 5th October, citing a benign inflation trajectory and a downward revision of inflation projection. The RBI lowered its inflation projection from 3.9% to 4.5% from 4.8% for the second half of the current financial year. In another macro development, India's trade deficit narrowed to a 5-month low at $14 billion in September, despite higher oil prices and even as merchandise exports entered the negative territory after a gap of 6 months. Exports were down 2.2% in September, while imports grew 10.5% in dollar terms. In rupee terms, however, exports and imports expanded at 9.7% and 23.8% respectively, mostly because of a sharp depreciation in the rupee. Given the country's dependence on imported fuels, the elevated crude prices and the modest expected impact of the measures initiated by the government, the current account deficit is now expected to widen significantly to 75 to 79 billion US dollars or 2.9% of the GDP in the current financial year. Moving on to unsettling news for the country's IT sector. Over the week, the US administration announced plans to apply additional curbs on the much sought-after H-1B visa. The Trump administration said that it is planning to revise the definition of employment and specialty occupations under the US H-1B visas by January, a move which could hit Indian companies in the US and small and medium-sized contractual firms. IT companies depend on these visas to hire tens of thousands of employees each year from countries like India and China. The Trump administration is reviewing the H-1B visa policy that it thinks is being misused by companies to replace American workers with foreign ones. Reacting to this news, the BSE IT index ended the day down by 1.3%. Now coming to the big question, what to do in markets like these? We have Girish Shetty, research analyst at Equitymaster, to help us answer that question. Hi Girish, and I'm glad to have you on board. Let's jump straight to the questions. You recently wrote a very insightful piece on how to deal with volatile markets, just like this one. Can you share some insights with our listeners?
So Prashil, what is happening is with media headlines like crash, crisis, volatility, now a regular feature, we have a situation which is very difficult for the retail investor to handle. What one should do in such a situation also depends on what kind of an investor you are.
Okay, that's interesting. So, what exactly are the different kinds of investors?
So I would say there are four ways in which investors react to such situations, or you can say there are four different categories of investors. Now coming to investor one would say, I can't bear this pain, this panic is too much for me, I better sell whatever I have left. And sadly what happens is a majority of the investing population falls in this category. Now many of them are new to the market and have entered recently during the bull run. Now they've not seen such a situation before with such a sustained correction, and they don't know what to do next. Investor 2 is someone who gets frozen in shock, fear and denial. Now he has no clue what to do and he is too shocked to react. What he would do is he would say better not to do anything. Markets will definitely correct more and I would buy at the bottom. But what is the bottom? He has no idea about that. Although investor 2 has a slightly better temperament than investor 1, he will avoid the mistake of selling at rock bottom prices, but he also won't be able to capitalize on the opportunity. Now investor 3, he is better than the first two categories. He tries to follow a contrarian approach, but in looking for supposedly cheap companies, he will end up with a lot of junk stocks which might damage his portfolio. Now the most interesting is the investor 4. A very minor part of the investing population falls in this category. Now these investors are normally calm. For them, this is the perfect time to look at quality stocks. By quality stocks, I mean stocks of companies that are household brands and which has an established track record.
Wow, okay, so investor 4 is who we all should aspire to be, isn't it?
Yes, I would say investor 4 is where you need to be. Now these investors are bound to do well in the long run. That's because they will buy the right stocks at the right time. Now we follow the investor 4 approach in Value Pro, a stock recommendation service for investors who want to make big long-term profits. And during times like these, it gives us an opportunity to look at quality companies that until now were off bounds due to the high valuations.
Thanks Girish, that was very insightful. I hope our listeners find it useful. Well, that was Girish Shetty, research analyst at Equitymaster and a part of the Value Pro team. Now, what kind of an investor are you? 1, 2, 3 or 4? Do let us know. And if you're interested in Value Pro, you can always log on to equitymaster.com/valuepro and check it out for yourself. Well, that's all from us today. Before signing off, we would like to know if you like our podcast. Is there anything specific you want us to cover? We would love your feedback. Just visit equitymaster.com and drop us a line. We look forward to hearing from you. Happy investing.